Welcome back to Chapter 6. We just dealt with how you account for the purchase of the inventory that you'll use to sell. Now we're going to deal with how you account for what happens when you sell inventory. Now, every time a business sells some of their inventory, there must be 2 journal entries in the perpetual method. The first entry when we sell inventory is a revenue journal. So we will debit cash or accounts receivable, however our customer paid for it, and we will credit the sales revenue or service revenue account. This is based on the price we sold it for. Remember, revenue is based on the sales price to the customer. Then we have an expenses journal. In this case, we will debit cost of goods sold, and we will credit our inventory account because we're going to clear out that inventory. It's no longer in the inventory closet. This will be based on the cost. Now, we could also, when we're dealing with our customers, they may return some things to us or ask for a sales allowance. Now remember, from the customer's perspective, it's considered a purchase return or purchase allowance. From the seller's perspective, which is what we're talking about now, remember, we're talking selling inventory, we're talking about sales returns and allowances. Just like when you sell, we've got to have a revenue journal, and whenever there is a sales return, we're going to debit the sales return and allowances account, and we will credit cash or accounts receivable. We will credit cash if we give them a cash refund, and we'll credit accounts receivable if we just reduce their bill. In either case, the debit to sales returns and allowances will cause us to reduce the net sales revenue. And once again, these amounts are going to be based on the sales price of the returned goods. When there is a return, we also have to have an expense journal. Because we are taking the inventory back into our inventory closet, we are accepting a return, we need to debit the inventory account, and now we need to credit the COGS account because that is no longer a good that was sold, so we need to reduce the cost. Remember, because this is an expense journal, we must base it on the cost of the returned good. Now let's do a problem to see how it works. We have got Cornerstone 6'3", Brandon Shoes again. They've now sold 100 pairs of football cleats to the local college football team for $12,000 cash. Now, Brandon had paid $10,000 for these cleats when it purchased them from its supplier. So this all happened on August 1st. Let's record this sale of inventory. Remember, we've got to have a revenue journal and an expense journal. So what would our revenue journal be? Well, we know we definitely want to credit a revenue account for the amount of the sale. This was the purchase price, so $12,000 is the revenue. And how did Brandon get paid? Well, it said it was for $12,000 cash, so we know there must be a debit to cash of $12,000. Now remember, we also need an expense journal. So what was the cost of those 100 pairs of football cleats? Well, we know that they were $100 a pair, and they sold 100 pairs of them. So we know that there is a $10,000 cost of goods sold to Brandon. And then what do we need to do to the inventory account? Well, those 100 pairs of football cleats are no longer in the inventory closet, right? So we're going to have to reduce the inventory account, in other words, credit the inventory account for $10,000. Now, 2 weeks later, that same local football team is going to return 10 pairs of those cleats for a cash refund of $1,200. So we've got August 15th. We need to now have a revenue journal entry. How do we deal with a sales return? Right. We're going to debit sales returns and allowances. And we're going to do it for the value of the sales return. And then it says they got a cash refund, which means we had to pull $1,200 in cash out of the register, so that's a credit to cash of $1,200. What will be our expense entry? Well, those 10 pairs of cleats are now coming back into the inventory closet, right? So I'm going to debit inventory for $1,000. Why $1,000? Because it's 10 pairs of cleats times what is the cost to Brandon of those cleats? It's $100 a pair. That's going to be the $1,000 coming back into inventory. And now we have to reduce the COGS that we had initially booked. So we have to credit that expense account for the same amount of money, the cost of those cleats, which is $1,000. Again, there is a sales return, and that sales return causes the revenue entry of a debit of the sales price or the return price, debit to sales returns and allowances, and then a credit to cash. And then the expense entry, there's going to be the debit to inventory and the credit to cost of goods sold. Now the accounting for the selling of inventory would be really simple if the cost of all the inventory that a company needs to purchase was constant over time. Because then we could say that the cost of goods available for sale was always the number of units in inventory times the cost per unit. And the cost of ending inventory would always be the number of units in the ending inventory times some set cost per unit. And cost of goods sold would always be whatever number of units were sold times that same cost per unit. It would not matter which units you pulled from the inventory closet to sell, and it would not matter which units remained in the inventory closet because all the units would have the same cost per unit. Is this realistic? Is it realistic to think that a company will buy their inventory at exactly the same cost per unit all the time? No, it's not. Because the cost of inventory changes over time, we need an inventory costing method. We need to figure out which units are we pulling from the inventory closet when we go to sell. Now there's a couple different ways of dealing with costs of inventory. How do you figure out which units you're using at any given time, assuming that the cost of those units is changing all the time? There are 4 methods. We are going to focus on 3 of them in this chapter: specific identification, first in, first out, and last in, first out. You will see the average cost method in your book, and if you'd like to check it out, I welcome you to do that. The specific identification method actually follows the physical flow of goods through the sales process. It literally follows that one unit all the way through the process. This is most common with large units like cars or highly expensive units like diamonds. You will actually have a serial number on every single one, and you will follow it all the way through the cycle. The other 3 methods mimic this, but they follow the cost flow, not the actual good itself. They just follow costs through the sales process. Now, the specific identification method is much easier even on cheaper, smaller goods, because we are able to give specific identification numbers to all sorts of things pretty cheaply now with digital and electronic tracking. However, you will learn other methods because not every company is able to do that just yet. Let's first focus on the specific identification model. You're going to try to figure out the cost of goods available for sale, and you're going to try to figure out after each sale what's the ending inventory and the cost of goods sold. Ultimately, you sum all of the costs of goods sold during whatever accounting period you're talking about, and you sum all of the ending inventories. Let's look at an example. Cornerstone 6.4 in your book talks about a company that sells beach apparel, Tampico Beachwear, and we're actually going to look at the purchase and sales of one of its most popular products, which is the Crocs shoes. Now, notice that in your book, in these cornerstones, they're actually color coding each of the inventory purchases. So the company starts the month of October with 300 units, 300 pairs of Crocs shoes at $16 a pair. Then they buy 600 more pairs. That's what we're calling purchase one here. 600 more pairs at $18 a pair. And they're in purple, not in blue. The reason being so that you can identify them. So you can see that those are a different inventory stock number. We have 2 other purchases, so 3 purchases altogether, and they are similarly color-coded. Now, what this actually shows us then, it says this is what was purchased throughout the year. We also know how many they sold each time when they made sales. But notice this. They actually are showing you for each inventory category, the ones they started with, the ones they got through purchase 1, the ones they got through purchase 2, the ones they got through purchase 3. They're showing you how many were left by the end of the month. Now, here we go. Notice that they sold 1,100 units here. And if you total all of these, they sold 1,100 units. They started with 300 units, they added 600, and then they added another 400, so they had 1,300 units available for sale throughout that month. If they sold 1,100, they had 1,300 available. How many should you expect to find total in ending inventory? Right. You should expect to see 200, which you do. But you know exactly how many of each inventory grouping was actually in ending inventory. So, could you compute the cost of ending inventory as of October 31st? Well, you know that there were 0 units left that cost $16 a piece. So that's $0, right? There were 50 units left that had cost them $18 a piece, right? So we could figure that. 50 at $18. We know they had 80 in the red, 80 units that had cost them $20 a piece. And in the green, we know they had 70 units that had cost them $22 a piece. So let's look at how that all pans out. 50 units at $18 gives us $900. 80 units at $20 gives us $1,600. 70 units at $22 gives us $1,540. And if we total that, the cost of the total ending inventory, that 200 units that were left at the end of the month, cost $4,040. Now let's use a very similar method right here to figure out the cost of goods sold. If we know that there were none of the $16 units left in inventory at the end of the month, they must have sold all of them, right? 300 units sold. There were 300 units available for sale, so they must have sold all of them. So 300 units sold at $16, which got us $4,800. Now, we know that in purchase number 1, 550 of the units that are worth $18 were sold. So 550 times $18 is $990. We know that in purchase 2, of purchase 2 rather, 170 units were sold at $20 a unit. And we know that of the third purchase, 80 units of that one were sold, and they were $22 a unit. That's $1,760. If we add all of these up, this should be a sum at the bottom. $19,860 is the value of cost of goods sold. Again, you just figured out how many of each specific inventory grouping was sold in that time period, in this case the month of October, and then figure out exactly how much each of those inventory groupings had cost per unit. And this is the conclusion of your second Chapter 6 video.